Welcome to the deep dive. Today we're tackling a question a lot of you might be wondering about, especially with the way the market's been.
Yeah, finding those solid anchors, it's tricky right now.
Exactly. So we dug into a recent Motley Fool article asking, is Berkshire Hathaway Warren Buffett's big companies at a buy right now? We're going to unpack their analysis, see if this giant still fits in your portfolio today.
Right. And we're focusing just on that Motley Fool piece from April 22nd, 2025. They've laid out the groundwork.
So our job is to kind of pull out the key bits and figure out what it means for you, the investor, trying to navigate things.
Precisely.
Okay, so first big thing, how's Berkshire actually doing in this, choppy market? Is it holding up?
It seems like it, yeah. The article points out something pretty striking.
Okay.
Well, year-to-date, mid-April, you had the Dow down about 8%, S&P 500 down around 10%.
Which we definitely felt.
Oh, yeah. But Berkshire, their stock was actually up 15%.
15%. Well, everything else is dropping.
That's
pretty telling.
It really is. That kind of resilience, it definitely gets your attention.
And the article mentions, all the talk about Buffett's succession.
Right, who takes over eventually.
Yeah, but it doesn't seem to be scaring investors off too much. I guess he's been pretty open about the planning.
He has, yeah. And that probably helps. But that strong performance suggests investors see something more fundamental there.
Beyond just Buffett himself.
Exactly, like a real belief in the underlying company.
So where does that strength actually come from? It's more than just his famous stock picks, right?
Oh, absolutely. That's a key point in the article. Owning Berkshire is owning a ready-made, diversified portfolio.
Good.
Yes, they've got huge stakes in public companies, Apple, Amex, Bank of America, Coke, Chevron. Those are massive holdings.
Right, big names.
But the real, core value, the article argues, comes from all the different operating businesses they own outright.
So not just stock market bets, but actual companies they run day to day. What kind of businesses are we talking about?
It's incredibly diverse across nearly a dozen sectors.
Wow.
The article highlights insurance, think GEICO, and energy through Berkshire Hathaway Energy. That's utilities, pipelines, a huge operation.
Okay, insurance and energy. What else?
Well, there's also manufacturing, retail, building products, food, financial services. Oh, and BNSF Railway, a major railroad.
So it's really spread out if one sector's having a tough time.
Exactly. The others can help balance things out. It's that classic diversification benefit, but all within one stock, sort of.
Okay, that makes sense. Now, the Motley Fool piece also talks about earnings, but it says to focus on a specific type of earnings.
Yes, this is really important and something Buffett himself stresses. Focus on operating earnings, not the standard GAAP earnings per share.
GAAP, generally accepted accounting principles, right? Why the distinction?
Because GAAP EPS includes these things called mark-to-market adjustments on their stock investments.
Mark-to-market, like the paper value changes.
Exactly. It reflects the short-term ups and downs of the stock prices in their portfolio. So if Apple stock jumps one quarter, GAAP earnings look huge. If it drops, they look weak.
So it adds a lot of, volatility, noise.
Precisely. It doesn't really show how the actual businesses, GEICO, BNSF, the energy companies, are performing day to day. Operating earnings strip out that stock market noise.
Got it. So you see the performance of the actual companies they own, and how has those earnings looked?
That's where the story gets really interesting, according to the Fool. Very strong upward trend.
Yeah.
Okay, so 2021, $27.6 billion. 2022, $30.9 billion. 2023, $37.4 billion. And then 2024, $47.4 billion.
Whoa, hold on. $47.4 billion in 2024. That's a huge jump from the year before.
It is. Nearly 27% growth year over year in operating earnings.
Okay, that kind of steady, strong growth from the core businesses. That helps explain the stock performance we talked about earlier.
Absolutely. The article connects that consistent operational growth directly to the stock's steady climb over the last 5 years.
Makes sense. Now, something else Berkshire is famous for. Cash. They're sitting on a mountain of it, right?
An absolute mountain, record levels. End of 2024, the article says $334 billion in cash.
$334 billion. Just, wow.
It's a staggering amount of dry powder.
And the Motley Fool piece argues this isn't just lazy money sitting around. It's actually a strategic advantage, especially now.
Definitely. Think about it. If the economy slows down or the market takes another dip,
they're ready.
They are incredibly well positioned. They can weather storms better than most. And crucially, they can pounce on opportunities, bargains that might appear.
Right. And the article links this back to Buffett's whole philosophy, doesn't it? His patience.
Exactly. He's famous for not wanting to overpay for acquisitions. He'll wait, And wait for the right company at the right price. That huge cash pile lets him do that.
Patience is key. And the article sort of hints that investors looking at Berkshire stock should maybe take a similar approach. Don't rush in and overpay.
That's the implication, yeah. Which naturally leads to the valuation question. Is the stock expensive right now?
Okay, so how does the article gauge that?
It looks at the price-to-book ratio, the PB, basically comparing the stock market value to the company's net asset value on its books.
And that's a metric Buffett himself has used.
Historically, yes. Especially for deciding when to buy back Berkshire's own shares, he saw it as a sign of value.
So what's the PB ratio now, according to the Fool?
It's around 1.7 currently.
1.7. And how does that compare historically?
Well, the article notes it's definitely on the high side for Berkshire. Buffett had previously talked about ratios closer to, say, 1.2 as representing really good value for buybacks.
So 1.7 sounds maybe a bit stretched based on that past benchmark?
It could seem that way, yeah. But the article adds some important context.
Which is?
That Berkshire is just unique. There isn't really another company quite like it.
With that specific mix of stocks and wholly owned businesses across so many sectors?
Right. You can't easily find a direct comparison. So because of that unique structure and the quality of the assets,
the argument is maybe it deserves a bit of a higher valuation now.
That's what the article seems to suggest. That even at a PB of 1.7, given what you're actually buying, starting a position might still make sense for long-term investors.
Okay, so it's not a screaming buy based on historical value metrics, but the quality and uniqueness factor in. It's nuanced.
Very much so.
So what's the practical advice then from the Motley Fool for someone thinking about buying Berkshire shares today?
Given that higher valuation, they recommend a cautious approach. Specifically, they suggest maybe buying in thirds.
Buying in third. You mean like splitting your investment into 3 chunks?
Exactly. Don't go all in at once. Buy some now. Maybe wait and see if the price dips to buy more later. It averages out your cost.
Okay, dollar cost averaging, essentially. But they still think it's a good long-term hold.
Oh, yeah. They strongly feel Berkshire deserves a spot in most portfolios because of that built-in diversification and the management quality.
And there's that huge cash pile again. The potential for what they could do with it.
Right. That's kind of the potential catalyst hanging out there. Yeah. If the market does provide those opportunities Buffett's waiting for,
he could make some significant acquisitions. Put that $334 billion to work.
Precisely. And that could really fuel future growth and potentially give the stock price a nice boost down the road. That's a key part of the bull case, the article implies.
Okay, let's try and wrap this up then. Recapping our deep dive into the Motley Fool's take. Berkshire's shown real strength lately, despite the market wobbles.
Definitely resilient.
It offers massive diversification. The stocks, yes, but really those core operating businesses.
Yeah, the insurance, energy, railroad, all that.
And those operating businesses are growing earnings impressively. Nearly 27% growth last year.
Very strong fundamental performance.
The valuation. Well, it's a bit high compared to its own history, using that PB ratio.
Around 1.7, yeah. Not historically cheap.
But the company's unique, high quality, and sitting on a mountain of cash that could fuel future deals.
Which makes it still compelling for the long term, even if you maybe ease into a position like buying in thirds.
Right. The article basically says, great company, maybe not a bargain price right now, but worth considering, especially if you're patient.
That sums it up pretty well. That patience theme runs through everything Buffett's approach and maybe how you should approach the stock, too.
So for you, the listener, the main thing to think about is how this unique, diverse company run with that patient philosophy fits your own goals, your own tolerance for risk. And maybe here's a final thought to chew on. With Berkshire holding so much cash, what kinds of specific market shifts or opportunities out there might be perfect for them to jump on? What could they buy that would really move the needle? Definitely something interesting to consider.
Yeah, good question to ponder.
Thanks for joining us for this deep dive.